Nitin Rakesh, CEO of Motilal Oswal Asset Management Company, now joins us on the show. Nitin, thank you so very much for being with us this morning. Just wanting to know, in an environment like this, which is so uncertain, where you have one day where the market really shoots off the charts, the next day you see it just coming crashing down. Many investors must be really jittery and must be wanting to know what exactly to do in a market like this, and what are you advising your clients right now?
Morning, Devina. I think very good question, primarily because right now what we are seeing is a divergence between the domestic environment and the global headwinds. So effectively what we are seeing is increased volatility, and I think if you remember, between Jan to March or April this year, we had extremely low volatility as measured by something like a VIX. So volatility being faster mean reverting, and it's kind of shot back up. We have to live with this volatility for the next few weeks at least. I think the best thing for investors to do right now, and that's what we are advising everybody we talk to, is not to panic in this environment. The markets come off about 10 to 12% from its peak. It's not to say that we have things that are going wrong in the domestic environment or on the fundamental side. So I think this is a godsend opportunity for people who would like to build portfolios, to use this volatility and correction that we are seeing right now to build portfolios with a 2 to 3 year horizon. And I think if you continue to focus on companies and sectors that have a very strong linkage to our domestic demand, consumption and growth story, there is very high likelihood that you will not go wrong, and you will actually make decent returns from these levels.
So Nitin, at Motilal Oswal, now which spaces do you still think have a lot of value to be unlocked, and probably clients, if they invest right now, they can actually reap the benefits going forward, maybe even in the shorter term period, probably for 10 to 15% an upside?
Sure. I think again, if you build on the theme that we just talked about, which is to focus on the domestic consumption story, clearly there are players that are in there. For example, automobiles, for example, consumer goods, even banks. I mean, banks is actually one of our top picks right now. And I think things to avoid will really be things that have high degree of correlation with the global markets. For example, commodities, especially metals. It's very hard to predict what happens in Europe, what happens in China, and hence it's very, very hard to take a call on what's going to happen to commodity prices. So realizations may fall or rise depending on global prices. So those are some things that we are recommending investors to try to avoid right now. But I think if you focus on things like autos, banks, consumer goods, capital goods, all of these are great opportunities right now.
Right. Good morning, Nitin. My question would relate more first to how you view liquidity flows or the availability of capital. Do you think whether it is the European crisis or whether China's uncertainty, if it is going to impact flows into stocks, which is secondary market flows, and whether you think it will be difficult for companies in the infrastructure space or the real estate space, I mean basically cash guzzlers, to raise easy money as we saw perhaps in the middle of 2009. If you could answer that question from just the availability of capital for cash guzzling sectors like infrastructure and real estate, and then for secondary flows into secondary markets.
Sure. I think from a domestic liquidity perspective, there is ample liquidity in the system, and I think even the actions from the Reserve Bank last night have aimed at strengthening that liquidity over the next 30 to 45 days. So we don't see any short-term concerns on liquidity, even though the demands are fairly high from a credit growth perspective. In fact, that's precisely the reason why we are very focused on banking as a sector, because we believe that the credit growth will actually pick up a lot more than what we've seen in the last 2 quarters. So I think there is ample liquidity in the system. There is all the levers of liquidity are with the Reserve Bank. Whether infrastructure companies, telecom companies, real estate companies, I think they should have ample access to liquidity, and obviously the price of liquidity will be dependent upon each individual company's project projections and their credit worthiness. From the point of view of the flows into the secondary market, I think the biggest variable in those flows really is the FII flows, and we've seen what they can do. In the first 3 or 4 months of this year, we got $6 billion of inflows, and in the last 3 weeks we've seen almost $1 billion out of that going out. So I think there is obviously a strong correlation between global environment and FII flows, and it's not so much that people take a negative view on India, but a lot of this money is tied into emerging market funds or emerging market ETFs, And hence, when you see a redemption in those, or when you see compression in values of other peers like China, rebalancing actually forces FIIs to sell out India and make sure that the portfolio weightages stay in line, because most of these portfolios are indexed to leading market indices. So I think global flows will and that's one of the biggest reasons why we see volatility, correlation between India and the global markets. So I think in the short term we'll have to live with the volatility of flows and hence the volatility of prices. But I think in the longer term, that should actually smoothen out, and we will still be one of the most preferred destinations for global investors to put money in.
Right. Nitin, just a two-part question here. Firstly, on the Indian financial system and the stability going forward, considering, there's a lot of talks about how interest rates are going to fluctuate going forward as well. And also currencies, that has also seen a little bit of a movement on the upside with the dollar index as a 52-week high. The impact of that obviously on the technology space. So two-part question with the financials starting off.
Sure. I think they're kind of related. Both are related questions any which ways. But effectively, looking at where we are from a financial stability perspective, I think we've had a fairly, well-defined movement from managing the crisis to business as usual over the last 6 months, and hence we've seen some efforts from the RBI to control inflation by using liquidity and then interest rate as a tool. So, given the fact that some of the global flows are slowing down, I think the impact of a liquidity glut causing inflation obviously is eased right now. So I think from a stability perspective, we have no concerns. The NPA position of banks is fairly manageable, actually very good. Credit demand is picking up in the system. Interest margins are fairly stable and growing. I mean, if banks like SBI and HDFC are talking about a 20 to 30% growth, at a top line and a bottom line level, then obviously there is fairly high degree of opportunity in that sector per se.
Right.
Going forward to the other part of the question about what happens to currency and the global macro outlook, again it's a very close linkage to dollar flows. We've seen $1 billion being pulled out in 4 weeks, and obviously the currency is showing that. It's also to do with the global strength of dollar versus the other basket of currencies, specifically the weakness in euro. Again, I think most Indian corporates have learned their lessons from 2008 and are managing the currency much better, and that includes the IT sector. In fact, if you see companies like Infosys have given projections at 44.5. So if rupee happens to be at 46 or 47, and if it stays in that range, then obviously there is an upside to the earnings that will come in. So I think broadly we expect that the volatility in currency to be in line with the volatility in the global dollar versus other baskets. From a manageability of those flows, from a manageability by Indian corporates, it should really be a function of.
Hey Nitin, thank you very much for joining us today.